What if you could lock in steady cash flow from your portfolio year after year? Picture dividends hitting your account like clockwork. Today, I'm sharing top 5 Canadian dividend stocks for 2025 that every investor needs to know about. Let's dive in. Hey everyone, welcome back to the channel. Today, we're zeroing in on Canadian dividend stocks, those reliable payers that can anchor your portfolio with income and growth. These 5 picks are some of Canada's strongest, with proven track records, attractive yields, and solid fundamentals for 2025. I've crunched the numbers, scoured the latest reports, and I'm excited to break down why these could be smart additions for the average investor. So let's get into it and explore these dividend powerhouses. First up is Fortis, a utility titan that's a cornerstone of any income-focused portfolio. Headquartered in St. John, Newfoundland, Fortis serves 3.4 million customers with electricity and gas across Canada, the US, and the Caribbean. It is regulated utility business, think government-approved pricing, delivers predictable earnings, making it a low volatility pick even in choppy markets. Fortis has raised its dividends for 51 years straight, earning Canadian dividend aristocrat status. As of June 2025, it trades at about $64 with 3.79% yield, paying $2.46 per share annually. In Q1 2025, net earnings climbed to $499 million from $459 million in 2024, fueled by a 7.2% rate-based growth and a strong US dollar. Fortis is investing $26 billion through 2029 to modernize its grid, targeting a 6.5% annual rate-based growth, which supports dividend hikes of 4 to 6% per year. Its recent 2025 International Edison Award for a transmission project highlights its innovation. For the average investor, Fortis offers stability, modest growth, and a yield you can count on. Next, we have Enbridge, a Calgary-based energy infrastructure giant. Enbridge operates North America's largest pipeline network, transporting 30% of the continent's oil and 20% of its natural gas. This business thrives on long-term contracts. 98% of cash flows are locked in, shielding it from energy price swings. Enbridge has raised dividends for 30 years, offering 6.12% yield at a $61.48 share price, paying $3.77 annually. In 2024, adjusted EBITDA hit $5.8 billion, and management projects 5 to 7% dividend growth through 2027. Enbridge is diversifying its renewables with 7.3 gigawatt of wind and solar projects, and its Q1 2025 $4 billion acquisition expanded its US gas utility footprint. Debt levels are high at 4.9 times EBITDA, but strong cash flows keep it manageable. For the average investor, Enbridge balances its high income with energy transition upside. Now let's talk Canadian Natural Resources, or CNQ, a Calgary-based oil and gas leader. CNQ's diversified assets, oil, gas, and synthetic crude, span over Western Canada, with reserves of over 13 billion barrels of oil equivalent. Its low-cost operations, like the oil sands mining segment with a $30 per barrel break-even, keep it profitable even in down markets. CNQ has raised dividends for 25 years at 21% compound annual growth rate, yielding 5.11% at $46.04 per share, paying $2.35 annually. In Q1 2025, adjusted funds flow was $4.2 billion. Its 2025 return on equity was 18%, well above peers. While energy stocks carry volatility, CNQ's scale and discipline make it a standout. For the average investor, CNQ offers high yield and capital appreciation potential, especially if oil prices hold above $70. Number 4 is Canadian Utilities, another Calgary gem with Canada's longest dividend growth streak, 52 years. This utility serves 1.3 million customers, mostly in Alberta, with electricity and gas distribution. Its regulated model ensures steady cash flows, with 70% of earnings insulated from market fluctuations. At $37.66 per share, it yields 4.83%, paying $1.83 annually. In Q1 2025, adjusted earnings were $232 million, with $630 million in operating cash flow, easily covering dividends. Canadian Utilities is investing $5.8 billion through 2027, including solar and hydrogen projects to align with net zero goals. Its ATCO subsidiary also dabbles in global energy ventures, adding growth potential. For the average investor, Canadian Utilities is a high-yield, low-risk play with a green energy kicker. Rounding out the list is Bank of Montreal, a Canadian banking icon since 1817. BMO has paid dividends for nearly 200 years, making it a dividend legend. At $144.27 per share, it yields 4.48%, paying $6.52 annually. BMO's US market exposure sets it apart from peers, with growth in high-potential states like California. Its wealth management and capital markets units delivered 12% revenue growth in Q1, diversifying income. With 13.6% capital ratio, BMO has room for dividend hikes and acquisitions. For the average investor, BMO is a safe, diversified pick with income and US growth exposure. That's it, 5 Canadian dividend stocks to power up your portfolio in 2025. Fortis and Canadian Utilities deliver unshakable stability. Enbridge and CNQ offer high yields with growth, and BMO brings banking reliability and a global edge. Please do your own research to see if these align with your strategy, but they're tough to beat for income and long-term value. If you're a new Canadian investor looking to start your investing journey, check out my referral links for Wealthsimple or Questrade in the description below. It will help you kick off your investing journey with a bonus. If you found this breakdown valuable, hit the like button, subscribe, and tap the bell icon for more investing insights every week. Thanks for watching, and I'll see you in the next one.